January 28th, 2026. Silver trades at $114 after recently touching all-time nominal highs near $117.75, yet the investment community is experiencing what may be the largest misinformation campaign in commodity market history. What we're witnessing isn't merely missed opportunity. It's a dangerous situation where retail investors are being systematically misled into positions that expose them to financial damage rather than protection during a genuine monetary crisis. When we last analyzed silver markets in early December, prices traded around $60. The analysis projected major supply disruptions could send prices to unimaginable levels. Less than 2 months later, silver has nearly doubled. Yet mainstream media, prominent analysts, and even major Wall Street institutions continue broadcasting narratives that directly contradict observable market realities. This isn't incompetence. It's coordinated misdirection with devastating consequences for uninformed participants. The scale of misinformation is staggering. Major financial publications tell readers to short silver and buy cocoa. TD Securities issued sell recommendations at $74 with stop losses at $92 and price targets of $40, stops that were hit within a week, while silver continued ascending toward $120. Citigroup revised their silver forecast from $50 to $40 in November, then abruptly upgraded to $150 in January after the rally had already occurred. These aren't minor forecast adjustments. These represent complete analytical failures or deliberate client positioning against their own institutional interests. What makes this particularly dangerous is the behavioral manipulation occurring across social media platforms. A coordinated narrative emerged telling retail investors, many of whom have never traded commodities, to short silver because it's too high, or it always crashes after parabolic moves. The cryptocurrency community, in particular, has been aggressively pushing short positions, with prominent figures messaging followers directly recommending massive short exposure at precisely the wrong moment. This represents potentially the first time in modern market history that a large retail cohort is attempting to short a commodity, experiencing genuine physical shortage rather than speculative mania. The consequences will be catastrophic for those misled into these positions. Shorting offers unlimited loss potential for limited upside, one of the worst risk-reward profiles in finance. Yet thousands of retail participants are being encouraged to take this exact position in a market where industrial demand is creating structural deficits that cannot be resolved through price action alone. The misinformation extends beyond simple price predictions into fundamental misunderstanding of market mechanics. Analysts claim retail is driving the rally when delivery data shows institutional and industrial demand dominating. They claim the Bloomberg Commodity Index rebalancing would crash prices Friday when the mechanics of index tracking make that scenario impossible. They claim Chinese export restrictions are irrelevant when China processes 70% of global refined silver and Shanghai inventories sit at 2016 levels while demand has exploded exponentially. This isn't market analysis, it's market manipulation through information warfare. And the casualties are mounting as retail investors discover their short positions underwater, with margin calls accelerating while the physical shortage intensifies. What follows is the analytical framework that exposes the misinformation, explains actual market mechanics, and identifies the forces creating conditions where silver prices could genuinely reach levels that seem unimaginable from current reference points. Understanding what's actually occurring at COMEX requires recognizing a fundamental shift in exchange operations that contradicts historical precedent. From the Hunt Brothers era through 2011, whenever COMEX intervened by changing margin requirements or trading rules, it was explicitly for the benefit of bullion banks to clamp down on volatility and protect the status quo of the paper-silver system. But what's happening now represents the exact opposite dynamic. COMEX is protecting itself from the overall situation rather than protecting bullion banks from market participants. The numbers tell the story. Anyone tracking COMEX vaults cannot deny the massive drain of physical metal from registered inventories. As of today, registered silver available for physical settlement of futures contracts sits at approximately 112 million ounces. Total silver futures open interest outstanding equals roughly 162,000 contracts, equivalent to 810 million ounces. We're approaching the threshold that analysts have warned about for years, the point where paper claims so dramatically exceed available physical metal that the fractional reserve structure of the futures market faces existential stress. What people ignored during years of warnings was how rapidly industrial demand for silver was growing, how inelastic silver supply truly is, and how inelastic the entire silver supply chain has become. It's insufficient to simply extract silver from the ground. You require refineries capable of processing mixed ores, transportation infrastructure to move material globally, and specialized facilities to achieve the 99.9% purity level demanded by industrial applications, solar panels, batteries, semiconductors, electronic components, and countless other uses requiring silver's unmatched electrical conductivity. Without physical silver, COMEX effectively becomes a pure paper market. But what's the purpose of a commodity exchange if the commodity itself is unavailable for delivery? Furthermore, CME Group is a publicly listed company with shareholders, multiple trading venues, and fiduciary responsibilities. What market participants tend to overlook is that if authorized participants fail to clear positions and outstanding obligations reach extreme levels, ultimately the exchange itself becomes exposed to losses. This vulnerability drove COMEX to implement a margin change that nobody, including sophisticated market participants, anticipated. They shifted from absolute dollar amounts to percentage of notional value. Today, they increased that margin from 9% to 11% of notional for initial margin requirements on silver futures contracts. They implemented similar changes across gold, platinum, and other commodities. This change protects COMEX because it eliminates the implied leverage increase that would occur as volatility expands under the old absolute dollar system. They've built a significant buffer based on current volatility levels that makes holding large positions, especially short positions, dramatically more expensive if you're not committed to immediate closure. Because it's calculated as percentage of notional, the higher price rises, the higher margins you must post immediately. This happens automatically through twice-daily margining operations. No announcements required, no delays for exchange committee decisions. If you hold short positions at COMEX, as price rises, you face a double squeeze. Higher margin requirements at the same time your positions are underwater. This increases the probability of forced liquidation because you lack sufficient capital to maintain positions. Meanwhile, participants holding long futures contracts are demonstrably there because they need physical metal. In January alone, delivery notices issued and accepted for physical settlement exceed 9,600 contracts, nearly 5 times the January 2025 volume. And January isn't even a major delivery month. March, June, September, and December typically see the largest delivery activity. The dynamic is clear. Longs willing to pay any margin requirement because they need the metal versus shorts facing escalating costs on losing positions where their hedges on other venues aren't generating offsetting physical metal to deliver against COMEX obligations. The most critical development that mainstream analysis completely ignores is China's physical silver shortage and the supply chain disruption this creates globally. People dismissing Chinese export restrictions as irrelevant are demonstrating fundamental ignorance of how silver supply chains actually function. China currently holds physical silver reserves at Shanghai Gold Exchange and Shanghai Futures Exchange at levels last seen in 2016, but demand in 2016 represented a fraction of current industrial consumption. China finds itself in severe physical shortage. When facing this scenario, what options exist? Close factories and terminate workers, or retrench defensively to protect strategic industries? China has chosen the latter, implementing prioritization systems where companies receive silver based on strategic economic importance. Jewelry sits at the bottom of the allocation hierarchy. Defense contractors, semiconductor manufacturers, and solar panel producers receive priority access. But even priority access means shortages relative to desired consumption levels. Reliable sources in Hong Kong report that no physical silver was permitted export from China throughout January. Furthermore, no onshore deliveries from Shanghai Gold Exchange or Shanghai Futures Exchange reached the Shenzhen market for physical silver demand. This represents unprecedented supply restriction. Critics point out that Chinese mining represents only 13% of global silver production. True, but irrelevant. Like rare earths, China controls the bulk of refining capacity, especially for industrial applications. Up to 70% of globally refined silver must process through Chinese facilities. Understanding refinery criticality requires recognizing why dedicated silver mines are so scarce. Because silver prices were suppressed for decades, most silver production occurs as byproduct of more profitable operations. Copper, zinc, lead mining. Large shipments of mixed ore travel to China where complex, expensive separation processes extract individual elements and refine them to industrial purity specifications. This is why refineries concentrated in China despite mining occurring globally. With China now implementing serious export controls until resolving internal shortages, this reverberates worldwide immediately. We're already observing physical silver draining from COMEX vaults on near-daily basis. Reliable reports indicate LBMA faces such severe physical strain that bullion banks are literally stripping physical silver from ETFs to meet delivery obligations. Contrary to what you'd expect during price rallies, SLV shares aren't increasing. 20 million ounces departed SLV from late December through today during the price advance. This creates extraordinary supply chain stress with massive repercussions. The misinformation around this topic is particularly egregious because critics focus on Chinese mining percentages while ignoring refining capacity. It's the processing bottleneck that matters, not the extraction geography. When 70% of refined silver depends on Chinese facilities and China restricts exports while drawing down domestic inventories, global industrial consumers face immediate shortages regardless of spot price levels. Shanghai silver premiums tell the story, currently trading $17 premium over COMEX without VAT. But more telling, on Monday, COMEX opened around 106 while Shanghai closed at 128.48 and traded as high as $131 equivalent. That's not a temporary dislocation. That's a market signaling severe physical shortage in the world's largest manufacturing economy. When Chinese buyers pay $131, while Western markets trade $106, it reveals which price reflects genuine physical scarcity and which represents paper contract settlement divorced from physical reality. The most disturbing aspect of current market dynamics is how aggressively retail investors are being pushed into short positions by coordinated misinformation campaigns. This represents unprecedented manipulation where prominent analysts, financial media, and social media influencers are simultaneously telling inexperienced traders to short a commodity experiencing genuine physical shortage. The behavioral psychology being exploited is sophisticated and dangerous. Critics claim silver is retail-driven mania comparable to GameStop. The data contradicts this completely. On Monday, 360,000 silver contracts traded at CME, massive volume suggesting retail speculation, correct? But examine the change in open interest. Only 3,000 contracts. That's less than 1% of trading volume resulting in new positions. The rest represented position rolling, day trading, and hedging activity by professional participants. Current open interest sits at 160,000 contracts, substantially below the 250,000 level typically seen near market tops. This is not speculative excess. This is professional positioning. The SLV short interest data further demolishes the retail mania narrative. Plenty of shares available for borrowing. The borrow rate for shorting SLV shares currently runs 77 basis points. In October, during genuine speculative pressure, borrow rates exceeded 10%. At 0.77%, this indicates minimal short interest and ample availability. If retail was massively long SLV driving prices, we'd see shares difficult to borrow and elevated rates. We see the opposite. Then examine zero-day to expiry options, the gambling instrument created by post-COVID monetary recklessness. Huge volumes in zero DTE options with put-call ratios above 1.3 to 1.4, heavily skewed toward puts in SLV. This represents pure speculation that market will decline, with positions expiring worthless daily as price continues rising. The important dynamic, delta hedging generated by these options creates enormous underlying volume. We're seeing $44 billion in trading volume that evaporates when options expire. Yet critics cite this as evidence of sustainable market moves. The misinformation extends to technical analysis claims. Analysts point to previous corrections claiming it always crashes after parabolic moves, but they ignore fundamental differences. Previous moves occurred during adequate above-ground supply and elastic industrial demand. Current conditions feature 300 million-ounce annual deficits that are widening, inelastic supply constrained by refinery capacity and mine development timelines, and industrial demand that cannot substitute away from silver for technical reasons. When retail investors ask why will it crash, the answer is invariably because it's gone up too much or because it happened before. When asked about supply-demand fundamentals, they have no answer. When confronted with delivery data showing institutional demand, they deflect to price charts. This isn't analysis. It's anchoring bias, exploiting investors' tendency to expect mean reversion without understanding whether fundamental conditions support that assumption. The professional analyst failures are particularly egregious. Major banks issuing research recommending shorts while their own institutional clients receive different guidance. The Bloomberg Commodity Index rebalancing scare represents perfect example. Prominent analysts claimed Friday would see massive selling as index funds rebalanced, crashing prices. But Bloomberg Commodity Index functions primarily as reference benchmark, not tracked by significant passive investment vehicles like equity index ETFs. The rebalancing already occurred over time without meaningful impact. Yet the false narrative encouraged retail shorts that got destroyed. What's occurring is sophisticated information warfare, where retail receives guidance designed to position them as exit liquidity for institutional participants who need physical metal or need to close underwater short positions. The casualties are mounting as margin calls accelerate and retail investors discover that commodity markets with genuine physical shortages don't behave like financial assets where mean reversion is reliable. Understanding current market mechanics requires distinguishing between wholesale institutional demand and retail liquidity constraints, a nuance completely absent from mainstream commentary. When someone posts on social media that they can't sell 5,000 ounces at their local coin shop, critics claim this proves silver isn't in shortage. This demonstrates fundamental misunderstanding of market structure. Local coin shops were designed to handle small retail flow, a few dozen coins daily, perhaps a few hundred ounces weekly. When someone arrives with $500,000 worth of silver demanding immediate cash payment, the shop operator doesn't have that float in bank accounts. They need time to find institutional buyers, arrange logistics, and receive payment before they can pay the seller. This doesn't indicate lack of demand. It indicates lack of immediate retail liquidity infrastructure for large volume transactions. The critical distinction: corporate industrial demand operates through completely different channels. They're not buying from local shops. They're contracting directly with refiners, dealing with bullion banks, or securing supply through commodity exchanges. The strain on retail is actually evidence of industrial demand creating tightness, because refiners need to melt coins, refine them to industrial purity, fabricate them into required forms, and ship them to manufacturing facilities. All of this has cost. All of this takes time. Regional premium structures reveal where genuine physical demand concentrates. In Hong Kong, China, and Japan, buyers pay premiums even at retail sizes because they want the metal immediately. The bid to purchase silver in Asia exceeds spot prices because industrial demand is proximate and urgent. In the United States, retail premiums remain more modest because industrial base is less concentrated and immediate demand less intense. But as 99.99% bars become scarce, and reliable reports indicate rapid depletion, even regions without significant industrial production will see retail premiums expand dramatically as any available silver gets pulled into the industrial supply chain. This is not speculation, this is observable reality unfolding. The misinformation campaign telling people you can't sell your silver at premiums, therefore shortage doesn't exist, exploits ignorance of how commodity supply chains function. Industrial consumers aren't buying from retail shops. They're draining COMEX vaults, stripping ETFs, and paying premiums in Shanghai because they need 99.99% industrial bars, not retail coins, requiring expensive re-refining. The premium structure will evolve as shortage intensifies. Currently, we see extreme premiums in manufacturing-intensive regions, while retail-dominated markets show more modest spreads. But when industrial refiners exhaust available bar stock, they'll accelerate coin melting operations, driving retail premiums higher everywhere. The lag between industrial shortage and retail premium expansion creates the false impression that shortage doesn't exist, but it's merely a timing difference in how industrial demand transmits through different market segments. When critics see someone struggling to sell silver at their local shop, they should recognize this as evidence of the market's structural transformation toward industrial dominance rather than evidence against shortage thesis. Let's address the manipulation question directly because it's causing dangerous confusion. Yes, silver price manipulation continues. In highly financialized environments with derivatives, zero DTE options, and algorithmic trading, manipulation remains a constant feature. But, and this is critical, manipulation effectiveness is declining because physical demand is overwhelming paper market influence. The evidence is observable in real time. On Monday, we saw prices surge toward 117s, then get hammered back to $100, then recover. This isn't random volatility. It's deliberate defense of critical price levels. Institutional analysis identified $100 as the threshold equivalent to SLV at par value, where maximum options expire out of the money, minimizing losses for option writers. Bullion banks and brokers defended that level with teeth and nails, because breakthrough would expose them to significant monetary damage. The price oscillated around $100 for days with enormous intraday ranges. Then the game stopped abruptly at 1:30 p.m. Eastern on January expiry, when American options expired. 1 minute after expiry, price immediately resumed upward trajectory. This isn't subtle. It's brazen manipulation timed to options expiry to minimize losses for institutions that sold those contracts. But here's the key point. Manipulation only controls short-term price action. It cannot create physical silver. It cannot force industrial consumers to stop production. It cannot eliminate the 300 million ounce annual deficit. Every manipulation episode that suppresses price simply makes silver cheaper for industrial buyers who must purchase regardless of price to keep manufacturing operations running. This accelerates physical depletion and worsens the structural imbalance that manipulation was meant to conceal. Institutional brokers are telling clients it's a good time to short silver without explaining why. They're doing this because their firms need counterparties to close underwater positions or need clients to provide exit liquidity. When institutional shorts need to close positions or deliver physical metal they don't have, they need someone to take the other side. Retail investors receiving short silver recommendations are being positioned as that exit liquidity. The regulatory failure is stunning. How can actions this obvious occur without intervention? The answer: regulators either don't understand commodity market mechanics or choose not to intervene because the alternative, immediate price discovery reflecting physical shortage, would be systemically disruptive. But this creates a time bomb scenario where suppression through manipulation delays but amplifies eventual repricing. What makes current manipulation particularly dangerous is that it's occurring during genuine physical shortage rather than speculative excess. In past cycles, manipulation could work because above-ground supply was adequate. Suppressing price temporarily was feasible because physical delivery demands could be met eventually. But when physical metal is unavailable at any reasonable price and industrial demand is inelastic, manipulation becomes a delaying tactic rather than a solution. Each manipulation episode stores energy that must release through even more violent price moves when reality overwhelms paper market games. The question isn't whether manipulation exists. Clearly it does. The question is whether manipulation can continue controlling prices when physical shortage reaches critical mass. All evidence suggests we're approaching or at that inflection point where paper games become irrelevant to physical market dynamics. When analysts discuss potential silver prices, they typically reference historical precedents or technical projections, but this approach fails when confronting market conditions that have no historical parallel. The framework for understanding where prices could go requires analyzing what would stop the advance rather than what would drive it higher, because driving forces are already clear and accelerating. Consider the supply-demand balance. Physical commodity pricing represents equilibrium between supply and demand. You cannot print silver. You cannot create digital silver. You cannot stimulate silver production through monetary policy. Supply is constrained by geology, refining capacity, and time required to bring new operations online. Demand is driven by industrial applications where substitution is technically impossible or economically prohibitive. The refining bottleneck alone creates multi-year supply constraints. Even if silver prices triple tomorrow, refineries cannot process material they don't receive. Even if new mines begin permitting today, production won't reach markets for 3 to 5 years minimum. Meanwhile, industrial demand grows quarterly through AI data centers, EV production scaling, solar installation mandates, defense manufacturing expansion, and 5G infrastructure deployment. Government intervention options are limited. It's a critical national security issue. Silver is embedded in sophisticated defense systems and essential electronics. But what can governments do? Open strategic stockpiles? That provides temporary relief while depleting long-term security reserves. Restrict industrial use? That crashes economic production and employment. Force mine development? That still requires years to impact supply. Forbid private ownership? Historical precedent shows this drives underground markets and international capital flight. The biggest constraint on price appreciation is whether industrial consumers have sufficient capital to continue purchasing at elevated prices. But corporations hold record cash after years of money printing and unprecedented profit margins. They cannot afford production shutdowns that would destroy quarterly earnings and crash equity values. So they'll pay increasingly higher prices for silver rather than shut down operations until they literally cannot source metal at any price. This creates the scenario where prices must rise until supply-demand equilibrium is restored. But equilibrium won't restore at low prices. It will restore at prices high enough to incentivize massive new production investment and potentially high enough to trigger genuine demand destruction through economic recession. Critics asking where will it stop are asking the wrong question. The question is what can stop it when industrial demand is inelastic, supply is constrained, above-ground inventories are depleted, and corporations have capital to pay higher prices rather than halt production. Some analysts claim substitution will occur, but silver's electrical conductivity is unmatched. For many applications, substitutes don't exist or dramatically reduce efficiency. Redesigning products to eliminate silver requires years of engineering, testing, and retooling. And even then, many applications have no viable alternative. The substitution argument represents wishful thinking rather than technical reality for the majority of industrial silver demand. Professional positioning during this environment requires understanding the difference between trading volatility and holding through structural shortage. For traders attempting to profit from short-term moves, the risk-reward has become extremely unfavorable. Silver can deliver 20% intraday ranges in either direction. Unless you have sophisticated systems, deep pockets to handle margin calls, and acceptance of potentially catastrophic losses, trading this volatility is essentially gambling against professional algorithms and institutional desks with far superior resources. For those holding physical silver, the framework is simpler. Recognize this as a long-term revaluation of sound money versus fiat debasement rather than a trading opportunity. Industrial shortage is real. Monetary debasement is accelerating. The gap between paper claims and physical reality is widening. None of these factors resolve quickly, Volatility will be extreme. Prices could pull back 20-30% multiple times during the ultimate advance. But pullbacks during physical shortages represent industrial buyers securing supply at temporarily lower prices, creating floors under markets rather than reversal signals. The misinformation about retail driving the rally serves institutional interest perfectly. It creates the narrative justifying short recommendations that provide exit liquidity for institutions that need to close positions or secure physical metal. When you hear retail mania as explanation for price moves, examine actual data. Open interest relative to historical peaks, short interest levels, borrow rates for ETF shares, institutional delivery demands at COMEX. The data contradicts the narrative completely. Political considerations add another dimension. U.S. midterm elections approach with administration wanting hot stock markets. Crashing the economy to resolve silver shortages serves no political interest. Trump has stated explicitly he wants equity markets elevated. Industrial recession to destroy silver demand contradicts that objective, so political incentives align with allowing silver prices to rise rather than implementing demand destruction through aggressive economic cooling. The regulatory capture question remains unresolved. How can manipulation be this obvious without intervention? The answer is that regulators face an impossible choice: intervene and potentially trigger immediate crisis as paper markets collapse, or allow gradual price discovery hoping somehow supply materializes or demand moderates. They've chosen the latter, but each delay makes eventual resolution more violent. What's certain, institutional investors are positioning now, not waiting for mainstream confirmation. Industrial consumers are securing supply through long-term contracts. Sophisticated capital recognizes that physical commodity shortages don't resolve through financial engineering. They resolve through painful price adjustments that ultimately incentivize new supply or destroy demand. Both processes require time and substantially higher price levels than current quotes. For investors evaluating whether current prices represent opportunity or excess, the question isn't whether silver seems expensive relative to recent history. The question is whether structural conditions support continued appreciation despite elevated prices. All evidence, from COMEX vault drains to Shanghai premiums to Chinese export restrictions to industrial demand growth to refining bottlenecks, suggests the structural case remains not just intact but strengthening. The misinformation campaign will continue because institutions need counterparties. Retail investors receiving short recommendations should recognize they're being positioned as exit liquidity for institutional participants facing genuine crisis. The worst position in commodity markets is being short during physical shortage, yet that's precisely where misinformation is directing uninformed capital. The casualties will be substantial, but the opportunity for those who understand actual market mechanics remains extraordinary.